Is it the world's toughest job to be the chair of the Fed or the governor of the Bank of England? Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. Today, we are going to look at what is ostensibly the nightmare scenario for a central bank in this current environment that we find ourselves in. We, of course, heard Jay Powell, the Fed chair, speaking today, bemoaning that we need disinflation in greater extent, that we need to get this inflation down, and that we may need to hurt growth to do it. And that, of course, is a tough thing, but the Bank of England and its governor, Andrew Bailey, would kill for those problems, because the situation happening in the UK is about as bad as global central banks fear in this current environment. And as it happens, this is exactly the central bank that we will hear from today make its policy announcement. So let's take a look at what they're looking at and how much of a cautionary tale this is for the Fed, for other central banks, and what this could mean going forward if you're a trader of U.S. stocks, if you're a trader of currencies, if you're a trader of commodities, because this is a great example of what these central banks want to avoid and the inspiration for wanting to avoid it. So let's first take a look front and center at what the problem is. Here is UK CPI. That's the yellow bars back there. It's lagged 7 months, and it's following behind UK inflation expectations in the 5-year break-even rate. That's the difference between nominal and real bond yields. When you take that difference, you are left with a residual that is that bond market inflation expectation. And the thing that should immediately jump out at you here is that it's going the wrong way. If in the U.S. you have perhaps inflation expectations that are anchored in place a little bit above target, but nevertheless, they're not rising, they're idling, and that's already a troubling thing if you hear the Fed tell it. We had surprise rate hikes from the Bank of Canada and the Reserve Bank of Australia this month because they were sticky, idling, not falling. In the case of the UK, they're not just not falling, they're going in the wrong direction. And of course, 7-month lag here is a bit long. It should make sense because we're looking at a 5-year break even, which is a little bit longer term than the 2-year we typically look at in the US. 5 years is the liquid one in the UK. So, of course, there's a bit of a lag because of the longer tenor. The lag is a little bit longer. The transmission mechanism is a little bit longer because, of course, markets are forward-looking, and so you should see the longer tenor break-even get out meaningfully ahead of currency CPI. And, of course, there's also a sort of lag in collecting data, in putting it into a report, in delivering that report. Incidentally, UK CPI was just updated last night in the most painful way possible. And what you have here then is a kind of sequencing where you can see that disinflation is in fact occurring and the break even did in fact anticipate it. You can see there the peaks line up, the troughs line up. But you've only managed to get things down from about 11% to just below 9%. And plainly, what inflation expectations are telling you now is that you're going in the wrong direction. The path of disinflation has been broken, and the Bank of England is now fighting uphill. So what's going on? Are they not tightening enough? Well, that certainly doesn't seem to be the case. So let's unpack what's occurring here. Here's UK CPI. Notice that what we've done here is taken apart the headline, that's the solid line there in the blue, the core, which in the UK excludes food energy, alcohol, and tobacco, which are seen as volatile. And so the dotted line there, the underlying inflation direction. And then what I've done is I've just broken it up by sector. So in the red is goods, in the yellow is services. And I think you can clearly see exactly what's going on. Headline CPI is in fact moving lower, as we saw here. And it seems to be goods that account for most of that, whereas services is plainly running in the wrong direction. And that's what's seemingly motivating core CPI in the wrong direction as well. That seems to be what's going on with inflation expectations. The actual underlying inflation rate, once you take volatile items out of the picture, in particular energy, of course, which is now a disinflationary force the world over with weakness we've seen over the past year, this seems to be the main issue. That at its core, literally, UK inflation is not responding to what has been a very aggressive rate hike cycle. As a matter of fact, we've had 440 basis points in rate hikes from the Bank of England already. They started at 10 basis points and, in fact, started before the Fed did in late 2021. They've now increased rates by 440 basis points, 4.4%, not dissimilar from what the Fed has done, although the Fed's done a little bit more in a little bit less time, but certainly a very aggressive rate hike cycle, and something is clearly not working. So let's see what that cautionary tale is. On the good side first, let's understand what is working before we get into the issues. Here, the story is a familiar one. You can see that global trade volumes started to come off as of March of 2022. That's tellingly the start of the Fed rate hike cycle. We've talked before about the Fed's ability to influence borrowing costs the world over because the US dollar, which is what gets moved around when the Fed acts, is the global medium of exchange, bar none. According to the Bank of International Settlements, as we've said many times here, the dollar is counterparty to something like 88% of global monetary transactions. So when the Fed raises rates, what it does is it raises the cost of borrowing the transactional unit for global commerce, or financing activity in the transactional unit of global commerce, full stop. So, of course, that's going to have a dampening effect on that commerce. And you can see here total global volumes, both exports and imports added up together, start to decline as the Fed really gets into the meat of its rate hike cycle. No surprise there. The UK very much in that boat. So you can see UK trade turnover following with just the slightest bit of lag, perhaps a month or two, behind what's going on with global developments here, and seems to be largely a story about central banks, and in particular the Fed, making their presence felt. So that part of the story seems to be working. Now, if we take a look back here, as we said, the key appears to be what's occurring in services. And what's occurring there will be a familiar story for U.S. economy watchers, and a familiar reminder about why what's happening in the U.S. needs to be watched and monitored and dealt with very carefully. The story here is wages. Take a look. What you see is UK wage growth seems to be what is the driver of services inflation, and that seems to be the driver of what's happening at the core. Now, wages, not surprisingly, are going to be particularly impactful for the service sector because most people are employed in the service sector. For most major economies, something like 3/4 of those that are employed are in the service sector. Manufacturing is much less people intensive at this point, never mind agriculture. So what you're looking at here is really a story about labor shortages. You can see that here. We, of course, look at this same kind of chart for the US all the time because it's much the same issue. What you see is a significant mismatch between labor supply and labor demand. You can see, generally speaking, here is the pre-pandemic average. So there seems to be about a 5 handle on this UK labor supply versus demand spread here. And we are currently at about a 2.2 handle here. So what's going on is you have significant oversupply relative to demand as COVID gets underway. Not surprising, people are laid off, there's lockdowns, same story as we see much of everywhere. Then as those lockdowns start to ease and global activity resumes, you start to get much more demand, so much so that it starts to eat up supply until you get almost to a mismatch. In the US, you're actually at a mismatch at this point. There's significant deficit of labor. It doesn't quite seem to be that in the UK at this stage, but you can see here the amount of excess supply relative to demand is about 50% lower now versus where it was on average before the pandemic. And you can see as you get this labor oversupply worked down and it becomes more of a shortage, inflation at the core goes up in almost perfect sync. So what you're looking at then is really the kind of situation that you have in so much of the economy around the world, where this is the part that's sticky. This is the part that's not easily adjusted down. You can raise interest rates and discourage the buying of goods and shipping activity and import-export activity, but it's very difficult to adjust wages once they've been locked in at elevated levels. And so this is the problem that we find ourselves in, compounded in the UK by Brexit. It might have been helpful right around now to be able to have unfettered access to labor markets in the European Union and to try to attract some of those workers without any real barriers into the UK to try to ease some of this. Well, that's not the option that policymakers are presented with here, clearly, because post-Brexit, it is not that easy to get migrant labor from the continent over to the UK with the right skill sets and at the right volume to plug these gaps. So what you're left with then is, if there is not enough supply for the demand for labor, you need to hurt demand, because you're probably not going to get more supply in the kind of volume that you need to really fix the issue concretely. So if you're going to actually get inflation under wraps, it's demand for labor that you're going to end up hurting. And that means slowing economic growth. That means hurting businesses, hurting the economy, and encouraging them to hire less, encouraging them to produce less, and in cooling economic activity that way, reduce demand for labor, reduce competition on wages, bidding them higher, and in so doing, actually start to work inflation down. So what you are faced with in the UK then is a situation where the central bank has to effectively choose between a self-inflicted downturn, perhaps even a self-inflicted recession, or letting inflation continue to rage, which are obviously terrible choices. And yet, here's where we are. How's that going? Well, not credibly enough yet, it would seem. Looking at where growth is sitting, in fact, there is, you can see a gradual deceleration through the central bank's actions and the Fed's actions and other central banks' actions. You can see manufacturing activity, as we see through the lens of goods inflation falling away, is still under 50. PMIs, of course, work on a logic where 50 is neutral, under 50 is contraction, over 50 is expansion. You can see here services still very much in expansionary territory, though cooling and expected to cool a bit more when the updated numbers come out this week. The composite, of course, clinging close to what's going on in the service sector because it is so much larger than manufacturing, as we've said here just moments ago. Manufacturing in contraction territory and seemingly shrinking faster month to month over the past 3 months, and looking to perhaps go even faster with this next update for June's survey later this week on Friday. So there is a degree of slowdown that's occurring, but if we look at what inflation expectations are doing, the markets plainly don't see that as credible. They clearly don't see it's enough, because if it were, then why would inflation expectations be doing this? They are very clearly rising. If the slowdown were sufficient, they would not be doing that, and yet here we are. So let's consider what needs to happen here, what we would be looking at. Well, here is this City Economic Surprise Index for the UK. It measures how data is performing relative to baseline expectations. Those baseline expectations derived from surveys of market-watching economists by the likes of Bloomberg, Reuters, who generally come up with these big median numbers where they poll 50, 100 market economists. They get expectations for a given number. They get a median. That's the median forecast. The number can come out above or below that, or roughly in line, of course. And if it surprises higher, this index goes up. If it surprises lower, the index goes down. It's also scaled by volatility. So if the surprise is market moving, it has a greater impact on the index than otherwise. So what you're seeing here then is a bit of idling, but at a higher level, and a recovery in data flow recently. Now, you might think, well, this is good news, but of course it's not if you're the central bank that's trying to slow things. So what's been happening here since the beginning of the year, and in particular into the second quarter, is not what markets would want to see if they want to give the Bank of England the benefit of the doubt on beating inflation back down to target. This is still an economy that's showing a good degree of buoyancy, even with how hampered it is. Most importantly, it's showing buoyancy relative to expectations. The markets think that the degree of BOE tightening really should be having a more painful impact, and it isn't. So data is seemingly supportive of doing more, because it seems to be surprising more on the upside than the alternative, despite a kind of recent idling and a dip recently through the 20-day moving average. So perhaps we are getting to some kind of a turning point here, but at this stage, clearly, the markets are not getting the kind of data that would make them think that the UK is doing enough to hurt the business cycle. In fact, if you look at the Bloomberg index of UK financial conditions, you can see they're actually a bit looser than average. When this index is above zero, that means conditions are a bit accommodative, and the further you go higher, the more accommodative they are. If it's below zero, that's tightening. That's tight financial conditions. You can see you really had much tighter conditions in the tail end of last year, arguably in the wake of the political turmoil that we've had in the UK. Certainly a very quick couple shakeups there at the premiership, and so a lot of uncertainty around that, of course. You had a fiscal plan from the very short period that Boris Johnson exited as Prime Minister. Liz Truss took over. She was there very, very briefly until Rishi Sunak took over. But in that time, she introduced a wildly worrisome fiscal plan, which seemed like it would require really dramatic tightening from the central bank. And you can see those spikes in the tail end of last year into tightening territory to really reflect that. Once she got bumped from the premiership, Sunak took over, and expansionary fiscal policy got shelved for the most part. Conditions eased, and you can see some of that here. Some of that also the relative level of support in UK equities, in sympathy with a level of support in global equities, as some of the US board and kind of broader macro forces look less worrying, like the banking crisis, like the situation in Ukraine, which of course is still awful and still continues, but hasn't really had a terribly impactful knock-on effect on global energy prices, say, or global wheat prices. As a matter of fact, those things are quite a bit lower than commodities in general. So there seems to be a bit of relative loosening here compared with sort of the averages as skewed by the turmoil late last year. But nevertheless, this suggests that compared with where we could be, there's room to tighten. And not surprisingly, a dramatic shift in the UK yield curve to reflect that. You can see much steeper now on the implied policy path, basically looking at a terminal rate of 6 at this point, and a hold there for a good 6 months, as compared with a peak under 5 that was anticipated as recently as a month ago. So we're looking here at a situation where the market clearly says, okay, the Bank of England is moving in the wrong direction on this. They need to be more aggressive. They need to tighten harder. Policy expectations, of course, tell you exactly that story. We at this point are baking in at least a 25 basis point hike at every single Bank of England meeting for the rest of the year. And you can see there is, in fact, a bit of a jump. So for this meeting that we have this week, one hike fully baked in, as you can see in the percent hike cut column, it's over 100, and a 37% chance for a 50 basis point move, less than even, but not insignificant. You can see 34 basis points in the implied rate delta column out of 25 that's priced in. So that's telling you you're heading into a 50 basis point type of a direction. When you get to August, there is already 3 rate hikes priced in. So you can see that by then you've priced in 76 basis points in tightening. So either in this outing or in August's outing, there is a 50 basis point hike that's on the menu. In September, another 25 basis point hike already in the market, and a slight chance that you would have a little bit more. Again, about a 40% chance that you would get a 50. Come November, another 25 basis point hike fully baked in. And come December, seemingly another. So the peak looking like 6%, give or take. Maybe we won't quite make it all the way there, but from there, you have a hold. So the market is looking at this and saying there is going to be dramatic tightening through at least the rest of this year. And if you want to get a good picture of it, here is a look at the spread. So consider the blue line there is where rates are baked in for June. The red is where they're baked in for December, so by the end of the year. Look at the widening gap in between these lines. That's those gray bars there, measuring that distance in between these things. And you can see you're looking at anywhere between 1 and 1.25% in rate hikes just over these next 6 months. So the market is already saying the Bank of England is going to be nothing but fire and brimstone here. Yet inflation expectations are going high. In fact, very tellingly, when these inflation numbers crossed the wires just last night, look what happens. The pound briefly spikes right there. It then settles, digests a bit, and falls. This is on inflation data that's meaningfully higher than expected, and a multi-year high, if not a multi-decade high, on core inflation. So plainly, what the market is saying here is the Bank of England will not do enough if what they're currently betting on is just one rate hike at every meeting for the rest of the year. That will not be enough to contain inflation. It will not be enough to beat back expectations. And so the pound will have its value eroded, will have its purchasing power eroded by price growth. Its value relative to physical goods will fall. That's seemingly what the market is saying here. So the Bank of England has a really tough job in front of it. It has to not just hike this go round. It needs to be able to come out and say something. This meeting, perhaps at the meeting in August, when we're going to get an updated set of forecasts and an updated quarterly inflation report, which is their version of the Fed's quarterly guidance outing, so-called Super Thursday, where they unveil not just what was said, not just the minutes of the meeting, not just the vote count from policy makers, hike or no hike. They'll unveil a much more complete outlook going forward. Until then, we're not going to get formal forecast updates, but between that and this, the Bank of England needs to come out there and say, look, if we have to choke the economy to get inflation down, we will. And they need to say it forcefully enough that the market finds it credible. And other central banks are going to be looking very, very, very closely here. We've already seen preemptive hiking from a few and some worried squawks from the Fed because they don't want to be in this precise position. They're going to be looking very, very closely to see whether the Bank of England is able to eventually bring the markets around. And if they can't, the cautionary tale here will be loud. And so other central banks looking at this will want to hike more aggressively to make sure that this isn't where they are. They'll want to be preemptively as combative as they can. And That, of course, will have implications for equity markets, negative ones, implications for precious metals, negative ones, and positive implications likely for the likes of the US dollar as a haven type of asset. As we get a kind of global consensus around, let's not be the Bank of England, let's take our medicine to the greatest extent possible so that we don't have to then inflict the kind of pain on the economy that the markets seem to be demanding of Governor Bailey and the rate-setting MPC committee at the BOE. And that is Macro Money for today. We are, of course, here every week, Monday through Thursday, right after overtime with our friend Chris Vecchio, head of Futures and Forex here at Tasty Live, where we break down the day's events and try to figure out a path forward and an interpretation and a reasoning for why things occurred and where they're going. I'm on with Chris again for Futures Power Hour on Fridays, and then on with Tom and Tony for First Call on Sundays. Outside of those shows, I'm writing for the tastylive.com blog and also opining on Twitter at Ilya Spivak. Thanks very much for joining me. Good luck trading out there. See you tomorrow.